Welcome to the BOSCHCAST with James Boschman and Denise Young, where we talk about Manitoba real estate and everything else that's on our minds.
Good morning. Welcome to the BOSCHCAST. I'm Denise Young.
And I'm Lisa Kanski. Thanks for having me, Denise.
Thanks for coming on. I'm super excited to talk about equity. But first, let's talk about a local business shout out.
Local business. Well, about a week and a half ago, I was on Kenaston, in just Kenaston Commons, and I found the Floral Fix. It's run by a local girl, and there's beautiful flowers in there as well as candles and gifts and some clothing. And the service was excellent, and I would really like to send people her way.
That's awesome. That sounds like a great little spot. Love to pick up flowers for people and little gifts. That's awesome. My local business of the week is going to be Woofs and Wags at 7 Donald. I'm sure I've shouted them out before, but in this incredibly cold weather, it's especially nice to be able to drop the dogs off and not worry about them for a day and let them get some exercise and some socialization with other dogs in a very well supervised manner. And so I know that they are safe. And what I love about 7 Donald is, or Woofs and Wags, and I say that because there's 2 Woofs and Wags in Winnipeg, and the one at St. Anne is great too. But my dogs like to go to 7 Donald because they have the smaller puppy room, which my dogs are my dogs are only 12 pounds. So Penny likes to be the big dog in the room, and at 12 pounds, she's on the bigger side in the room, and she's just a happier dog then. When we go to St. Anne's, she's like, no, I don't really want to go here because they get 35 pounds in the room.
Right. Well, I have a 20 pounder at home, so I'll have to give it a try. He could use some socialization right now as well.
Yeah, they're really great there, and it's a new building for them. They were down the road at 2 Donald, and it is a new building for them. But the dogs have so much space here, and having watched the renovation that they did online, like the type of flooring that they put in, which is really great for the dogs' feet and stuff, like it's just looks like a great facility, and my dogs love it. And my dogs are really picky, so they will tell me when they don't like something. There has been places that I'll try to take them, and after they've been there for a time or two, Penny will literally poop on the front step because she doesn't want to go in.
That's her way.
Yeah. So yeah, she gets her point across somehow. So yeah, that's that. So yeah, today we're going to talk about home equity and why it's important and what we should do with it, and all that stuff, and what we shouldn't do with it. Sure. That might be an important thing too. So Lisa, what is home equity and why does it matter?
Well, so I just want to explain to you my background. I'm a broker with Castle Mortgage Group here in Winnipeg. So we have been doing this now about a long time.
A long time.
Well, that's all I'll say. Long enough to have seen rule changes and lots of change and a change actually in attitude towards equity in your home. And what I mean by that is I find that when it comes to accessing the equity, meaning taking what value you have in the home that's just sitting there in the bricks and mortar and leveraging it to do something with it, can be really emotional for clients. They haven't really thought about it because we're still our parents' children and our grandparents' children who told us, pay cash, pay down that mortgage as fast as possible. The best debt is... Oh, sorry,
I think I lost you. Oh yeah, you're back.
Okay, sorry. So the best debt is no debt, of course. It's not practical. People have debt, right? And trying to, especially first-time buyers, trying to get in the game on the price of homes right now, it's going to take a long time to pay that mortgage out. So it's not practical anymore to be, if you have other debt, credit cards, lines of credit, car loans, student loans, seeing a lot of student loans these days with first-time buyers. Every other loan that you have is going to have a higher interest rate than what you can get on the mortgage, because that's your best collateral. And your home is the only thing that's hopefully growing in value as you live there. So that's wonderful. And if it's your owner occupied property, any money that you take out of the home, you don't have to pay tax on that.
Right.
And people don't really think about that. So no, I'm just going to save $20,000 instead to pay for whatever they're looking to do, which we can talk about. Well, to earn $20,000, you've got to make whatever your tax bracket is. So $26,000, $27,000 to make the 20 you could take out of the home now.
Right. That's awesome. That's awesome. So what are some of the smart things to do with your equity?
Well, the magic number is 80. And that is because when you buy a property, you can put 5% down. And I just want to put a plug in there for anyone who owns property now. You can buy another property for 5% down again. I see that misconception a lot. People think they need more of a down payment. They actually don't. As long as you're going to live in the property, you can buy again with 5%. But once you own that, so you're basically borrowing 95% of the value of the property up front. Once you own a property, the government changed the rules a few years ago and told the banks that CMHC and SAG and our insurers won't insure any mortgages for a property that you own if you're going to refinance. So that means take money out of the property. So
Right.
Because of that, we can only do up to 80% of the value. So for example, if you have a $300,000 home, then the most you can borrow against that property once you're living in it is $240,000. So math-wise, when you buy with 5% down, it does take some time because the house has to grow in value. You have to pay the mortgage down enough that there's room for that 80%.
Yeah. And that's
However,
kind of why we're talking about that this year, because a lot of people are having to renew from their 2020 purchases. So they would have had low interest rates, and values from 2020 to now have increased so much. So a lot of those people will have a lot of good equity. And so we felt like it was important that this is a good topic to talk about this year. People are going to need to renew probably at a much higher interest rate than they had from 2020 or 2021. And also, if they can't afford those payments, one of the things they could look at is doing a refi or there are options. Plus, there's other things they could do with some of that money if they did that.
Exactly. Yeah. So basically, if you have equity in your home, so let's say you owe $150,000 on a $300,000 home, that's 50%. So you could go up to the 240. So you've got about 90,000 there if you qualify, right, that you could use. So what can you use that for? Really, the banks want to know what you're using it for, but there's almost no wrong answer. So I've had clients want to do renovations. Renovations is a great way to use the equity in your home because you're not only getting those renos done that have been sort of hanging, you're increasing the value as well, hopefully, if those renos make sense. So almost like a purchase plus improvements when you buy, if you're going to redo the kitchen or the bathroom or flooring or the mechanics, like a new furnace, those kinds of things can net you a higher value for the property once those renos are done. So that's a very smart way to use to get at that, to get at the funds to do the renos.
Yeah. That makes sense for sure.
Yeah. I've had clients do refinances to pay debt down, and that's a big one. And coming out of COVID now, I mean, we're still not quite there, I think, in a lot of respects, but people had to incur some debt that they just are having a hard time getting out from under.
Right. House prices have gone up a lot, but so has everything else. So I think everyone's struggling. And then when you have to renew a mortgage at like double the interest rate that you had, I could see needing to consolidate. Yeah. Smart ways to use the debt would be to lower the mortgage payments, maybe so that it can make it easier to afford all the other things that have gone up in price.
Well, I'm finding that with lines of credit and credit cards, they're interest-only payments on the lines of credit, personal lines of credit. That interest rate, because the prime rate was so high for a long time as well, those rates on lines of credit were 9-10%.
Right.
So making interest only sounds like a good idea, but like, you're not paying the principal down. So you can continue to make those interest only payments, but you'll never pay it off. You'll never get out the principal.
Yeah.
So rolling it into the mortgage, not only are you cutting the interest rate practically in half, but you're also going to pay it down, pay it off. Right?
You'll get it paid off eventually.
So, yeah. And when I say emotional, I mean, I've had some clients have struggle with the idea of, I bought the house for $250. I know it's worth $300, but I want to pay this mortgage out because if I go from $150 back up to $200, I'm going backwards. You're not in the sense of the house has increased in value up to $300,000, which is wonderful. I kind of see it like, an apothecary table. It's got all the drawers. Yeah. So that's your debt. So you've got a drawer for your mortgage, a drawer for your car loan, a drawer for your line of credit cards at 20, 30%. We've seen astronomical student loans. What if we took all those drawers and put them together and gave you one rate of wherever rates are today? So 4.19, 4.4, depending on where you fall. You would do that. If you looked at your credit card of 30%, your line of credit at 10%. And not only that, it's cash flow. So I was just looking and check my notes here. I looked at it. When a client I'm working with right now, they owe about $200,000 total, $150,000 on their mortgage and about $50,000 in other debt. So there's a car loan in there, a credit card, and a line of credit. So we can pay it all off, and their payments are $1,072 a month. Right now they're paying $2,300.
Wow.
That same debt. We're doing nothing. We're not getting any extra money for renos, even though they could. We're just clearing out what they have right now.
Yeah. So, and that's not to say that they have to only pay the 10, right? They could make their payments 15 if that's comfortable for them, right? And then they're still going to pay it off faster.
Exactly.
And get, their equity built to do something else down the road. I'd say the one, I always like to talk about a little caveat with like paying off debt. Like make sure that you're budgeting and setting up your lifestyle so that you're not accumulating a whole bunch more credit card debt after you've done a consolidation, because you don't want to be doing this every 2 to 3 years, 2 to 5 years, whatever. And like, because that's when it becomes, I'll say, dangerous to your future, right? Like, is when you're living a lifestyle that requires you to refinance your mortgage to pay off debt constantly. Those are the people I see end up in trouble with their mortgage down the road.
Exactly. And it's funny because people will say, what can I qualify for? What's my max? And I say back, I don't know. What is it? And we talk about the practicality of that's pennies out of your pocket, I call it. That's your money. So if you have a lifestyle, like you mentioned, Denise, where you like to eat out a lot, or you like to travel, or you're helping family. I see that a lot too. They're, helping family get back on their feet. Those are things that you've got to be practical about, and being aggressive on the mortgage is great. But you can also have a comfortable payment and then just know that you've got the freedom to raise your payment if you wanted, or make lump sums up the road. But you're right that it comes down to budget and what's realistic. And I have seen clients do that because they want to be really aggressive on the mortgage. And then in a few years, I see them back because it's too aggressive and there's no sort of safety net.
Yeah, they haven't left themselves enough money to actually live a life, buy groceries.
Exactly.
But yeah, there are a few other things that you could do with that equity that could actually be like income producing, like income properties or stocks or business ventures. Buying a vacation home isn't necessarily income producing, but it will also build equity. So as long as it's being taken care of. So that's another thing. Like I see a lot of people leveraging their equity to do is buy a vacation home. Like I think the two that are the best for ROI are renovations and vacation homes and rental properties. So that's 3 actually.
That's great. And just to jump in there, vacation homes, you can actually buy a vacation home with 5% down because it's considered a secondary home. 10% depending on the type of, if it's a cottage, depending on the type, a cottage that they call it 3-season, you need 10%, but for a regular cottage, all season running water cottage, you can do 5% down. Rental properties, you need 20%. But it's amazing how many people have the equity in their home to do that. And they're trying to save for that down payment, where you can do it in such a way. And we'll talk about HELOCs in a second as well, home equity line of credit, where you can set it up in a HELOC so that it's almost separate from the mortgage, your current mortgage on your owner occupied property. You can leave it almost in two components so that you can track it as well, because investment properties come with your accountant wants you to take.
Right, exactly. What about reverse mortgage?
Reverse mortgages we're going to see more and more of them. And I've said this to friends, and sometimes they roll their eyes at me because they know I'm getting on my soapbox. But just as a general society kind of comment, I'd like to see us relax a little bit and not be so hard on people that have mortgages in their retirement. It's just not practical anymore, Denise. And I'm seeing people work their fingers to the bone because they have to pay that mortgage out by the time they retire. And then your health, your all of it, and it's okay to have a mortgage, especially when it's, it's not sizable. Let me put it that way. It's another, debt. So reverse mortgages are for people that find they're in retirement. They don't have a lot of income to support getting a traditional mortgage, but there's lots of equity there.
Right.
However, I've got a few banks that have created programs for these people as well, in those situations, that if there's lots of equity in the property, that income isn't as important because there's so much equity there. So it scares people, the idea of the reverse mortgage, because what's happening is if you don't make payments, that's okay. The balance will continue to rise. However, so does the value of the property.
Right.
So when you look at the math behind it, if you owe, say, $100,000 on a $300,000 property, even at a 3 to 5% growth, that $300,000 property next year is going to be worth hopefully $309,000, $315,000 in a good year, or in a conservative year, right? On
an average year, yeah.
On an average year. So if your $100,000 balance goes up a little bit, there's still tons of equity there. So we'll start seeing a little bit more of that. And also, I've heard a lot of talk about, we've got to pay the mortgage off before retirement, but we have $50,000 owing on a line of credit. Like, I've seen a lot of debt. And it's because people in your 40s, 50s, their kids go to school. University is really expensive. They want to help their kids. Like, it's not that they're bad with their money. It's just.
Well, I feel like people, in like Gen X boomers they're having to spend a lot more of their money, helping with school, but also helping their kids buy houses. Right. So it's putting them a little bit, I'll say, behind. I mean, they're not necessarily behind, but they're, everything's so much more expensive than it was when our parents or grandparents were retiring. Right. Yeah. So it is a lot more unrealistic to think that we can do it with less debt and more savings. Right. Like, yeah,
exactly. And if we go back to that apothecary table idea where you're just using your property that you've put your blood, sweat, and tears into to just put yourself in a better cash flow position, a better interest rate position. Yeah. It's not meant, like you mentioned, to just keep doing this every few years and then, going crazy with spending. It's meant to be smart about how you use it.
And I like to mention, like, so if you don't do a reverse mortgage, yes, you might be leaving more behind for your family when you pass. But on the other hand, being able to help them with down payments and other things while you're alive is also very beneficial and, maybe more appreciated even, right? Because you're helping them while they're younger when they need the more help.
And I've been hearing that more from people. I have friends with, people in my age group, their parents are getting up there and are saying, we can't take it with us.
That's right.
So, it's sitting there and as long as they're smart with their money as well. And
you don't want to spend it all before they pass either, but
no.
But those are some good ways to use it. What are some of the big mistakes you're seeing people do with their equity?
Not taking advantage of this opportunity. to be honest. And no one expected, I mean, there's a really big misconception out there with rates, because I'm trying to be politically correct here what I say. The media only reports on the Bank of Canada prime rate, what they do. And they're also reporting on something called the overnight rate, which affects the prime rate. And it's very confusing.
Oh, absolutely it is.
Right?
Yeah.
So there's so much misinformation out there. Fixed rates and variable rates are two different things, and they're actually influenced by some of the same factors, but they don't move independently. So our prime rate is what our lines of credit were attached to. And that prime rate during COVID went up over 7%. Right. And it was at 2.45, I think, for a few years. Don't quote me on that, but in the twos.
Right.
So our lines of credit are, especially on our properties, if you have a HELOC, a home equity line of credit on your property, the going rate there is about prime plus a half. So when the prime rate was 245, your rate would be 295. Amazing. Well, when I went up to 745, your rate's now 795. And it was like that for a few years. So it's that prime rate that's been starting to slowly come down, which is great.
Yeah.
What I think people need to realize is that we're kind of back into, I don't say historical averages anymore. I just can't. COVID and this whole 4 or 5 years has just made the graphs go haywire. Right. But fixed rates are back in that 4% range. It's not bad. It's not, I know it's not 2%. Yeah. I know that people have mortgages under 2%. I get it. But we all knew it wasn't going to last forever.
Right.
So one of the big mistakes I think people don't realize is that there is potential leverage of your property, right? And not being open to it, again, for that emotional reason. And if you don't mind, I'll just tell you a quick story about a lady who, in her 60s, bought her house for $80,000 in Winnipeg, and it was now worth about $300,000, and that's just city assessments. So I'm sure it was worth more. And she owed about $100,000 on her mortgage because she had refinanced. And she had $50,000 of debt because one of her family members was going through a really tough time and she had to support them.
Right.
And she could not get out from under that debt. Oh. That debt was hanging over her head to the point where her credit was affected because she was at the limits for everything. And she just couldn't settle with doing a mortgage for $150 because she bought that house for $80,000. There's no way she can owe $150 on it, even though the house was worth $300,000.
Wow.
Right? Because it was so emotional. I don't know a better word for it. Right. So I said to her, what if I had a magic wand and I could pull it around all of your cards and make them all, I think at the time we're at 3.5%. And she couldn't do it. She just didn't want to do it.
Wow.
Yeah. And I think about her a lot. And I'm not a pushy, I don't consider myself a salesperson. I only help people make decisions, and what you're comfortable with, I'm comfortable with. Yeah. So I can only, suggest and look at options, and I let people decide what they want to do. But yeah, I think about her. I don't know if that debt ever, and I would never want her to think she has to go into a consumer proposal or bankruptcy for that debt when we had the opportunity, and the cash flow would have been $1,000 a month less.
Wow. Wow. Holy moly.
Yeah.
I know it is definitely an emotional thing, like, for a lot of people. And then it's not for so many people. I've seen people refinance to pay for a wedding or, luxury cars or vacations. And those are, in my opinion, big mistakes, right? Like, I mean, yes, you want to maybe the vacation of a lifetime once, right? Like, but don't make it a lifestyle of refinancing, right? So I feel like that is where we tend to, make that mistake. But yeah, I feel like a situation like that, or back in many years ago when I was trying to change careers, we had a lot of equity in our house at the time. And I was in a job that it was just making me miserable, right? Like, and I just couldn't fix that somehow. And it just wasn't a good fit for me. And I was like, what can I do? And I had an amazing financing person that told me that I should use my equity in my house to start, because I really, really did want to do real estate, but it costs a lot of money to get into real estate. You have to have a good cushion. And I won't say I used my whole HELOC, but having that as a cushion to start my real estate career was like life-changing, obviously, because I could get out of that job.
Yeah,
And,
right.
So sometimes, we do have to, we don't have to, but we should look at those options, like if you wanted to leverage your equity to go back to school for retraining or stuff like that. Like those are smart ways to use your equity, right? Like, to give yourself a better life.
Yeah.
And,
Good return of investment for sure.
Yeah, exactly. Yeah.
I did something similar when I left. I was a teacher before I did this job. So I had a HELOC on my mortgage as well, not knowing all the stuff I know now. So I'm kind of proud of myself.
Right.
But I have to give credit to the broker that talked to me about that idea. But
Exactly.
same thing, I didn't, have to tap into the whole thing, but it was nice to know. And just for anyone out there who isn't sure how a HELOC works, it's just a line of credit with a much better interest rate attached to your property that's fluid. So you can borrow against it, pay it off in full. It's almost like an open component mortgage at the best interest rate you're going to get on an open product, meaning it's fluid. You can borrow against it, pay it off, not use it, rainy day.
Awesome. Okay, so that I think we've covered everything. What do you think?
A lot. I think,
So I'm just trying to think if we've missed anything. Look over my notes quickly. We've kind of went over what to do, what not to do, why it can benefit you, especially on a year when everyone's going to be having to renew even though they are very good rates this year, they're still quite a bit higher than what people are used to paying from that 2020 when they last renewed or bought. And consult a professional. Lisa's one of my favorites, so give her a call. Consult a professional, and there are many out there that will help you figure out what's best for you and give you all the facts so that you can make the decision that's best for yourself. And that's
the only other plug I'll say is if you ever hear of the government wanting to change the rules for the equity in your home is taxable, meaning right now, if you sell the property you live in, your owner occupied, rentals are different. But if you sell the property you live in now, you keep all of the proceeds. You do not pay tax on that. The government's looking to change that. So if they do, we need as a community to speak up about that.
That's right. We want to keep that the way it is, definitely.
And the reason they're doing that is that they're trying to stop the people that are flipping, saying they're living in it. Like they're trying to put a stop to only a small part of the mortgages on the books in Canada. So for people like us, we don't want that.
No, they need to address that somehow differently. Like figure out who's actually doing that and figure out how to.
Well, one idea they have is that if you only own the property, I think for less than a year, you have to pay a certain percentage of tax. Yeah. But even that, I think, is a bit unfair because I've had clients, first-time buyers, even just not be settled in their neighborhood or your job transfers you.
Right.
That's not. You're not. There's nothing nefarious about it, right? So.
Right. Exactly. And suddenly you're paying a bunch of income tax on. It probably isn't a lot of equity in most cases, but if you did happen to do a bunch of improvements when you first moved in, there could be substantial equity.
For sure.
So that makes sense for sure. Yeah.
Okay. Well, thanks for your time, Denise. I appreciate it.
Thank you for being on with us. I really appreciate you coming on. I know it's a lot of time out of your schedule because I went back and forth with a bunch of notes ahead of time and stuff. Okay. But yeah, thank you so much, Lisa. We really appreciate it. And to everyone who watched the BOSCHCAST, if you know someone who is probably going to be renewing this year that bought in 2020, please pass this on to them. Don't forget to like and subscribe. And thank you so much for listening.
Thanks, Denise.
Take care.